Hi, Larry Gaines, Power Cycle Trading. Well, one of the better setups for trading this kind of market has been to sell volatility. So what I'm looking at here is the Google, and they just released earnings yesterday after the close. So what we were looking at here was an expected move. They were looking for an expected move of plus or minus 5% from yesterday's closing price. So it closed at about 1073, and the market was expecting the implied move. Kind of a normal move would be up potentially either to 1124, that would be about 5% up, or down to 1020, about 5% down. So you can see the earnings were released, and you can see now it's right into that expected move. Now, the way that you can look at some of these earnings trades is selling implied volatility. So in this situation, here's the implied volatility in blue, and you can see how that collapsed after the earnings release. So we want to take advantage of that collapse. And so one way to do it is selling way out of the money bear call credit spreads or bull put credit spread to take advantage of that really high implied volatility. Now, Google, here's Google, and this was yesterday going into the close. So it was trading, going out at 1073, 4 days to expiration. The implied volatility was 54.62%. Now, normal implied volatility on Google, you can see, is around, we'll call it 30%. So that was giving an expected move of $53 potentially up or $53 down for the balance of this week, for the next 4 days. So again, you can see it did hit here today at down right now. It's down close to that 5% or a little bit beyond that 5%. So it's having that move down. You can see up here it's down $5 or 5.11%. So it's hitting the expected implied move. So one way to trade this is then to sell, better than the expected move. So this is 5% up, 5% down. This was selling 9% up and 9.5% down. So selling a bear call credit spread here at 1180 and a bull put credit spread here at 970. The other way I look at this is call it a synthetic short strangle. So you're just basically shorting this way out of the money call, way out of the money put, but surrounding it with a call to the upside and a put to the downside as your protection. So if you look at the history of Google over the last 10 earnings cycles, it moves about 5% up or down. Okay, so if you look at everything, it doesn't tend to move more than 5% up or down. So by doing a 9%, selling a 9% out of the money bear call credit spread and a 9% or 9.5% bull put credit spread, you go into that trade with basically that was selling like a 5 delta. So you go into that trade with a 95% probability that the market will close between your two short strikes. So here's what this looks like. So this is what we call an iron condor credit spread. So basically you're not getting a huge amount of profit, but what you're doing is you're getting a high probability of a winning trade. So in this trade example, we were selling this, so we were selling a bear call credit spread here at 1180. That was like a 4 or 5 delta. And so selling that the 1180, 1185, and then selling way down here the 970.65. So this brought in a total of 50 cents or $50 credit. And as soon as that earnings were released, this thing collapsed, and you can see the bear call credit spread 1180.85 went to zero, covered in the 965 bull put credit spread at 5. So this will make $45 per contract, but it's basically statistically a 95% probability winning trade. So that's what seems to be working right now, taking advantage of that high implied volatility and selling premium.